Hello, I'm Daniell Day. This video contains a financial analysis of Rio Tinto, the mining giant. In Australia, Rio's major products include aluminium, copper, diamonds, iron ore, and other minerals and energy. Corporate governance is a system of principles, processes, and policies. Rio has a system of committees which report to the board of directors. There are 11 members on the board of directors. The board consists of a chairman, a CEO, a CFO, and 8 independent executive directors. This results in an outsider-based structure. To determine if the board is structured in an independent way, where the CEO does not have undue power, we will apply a Kalpar's test. In the simple form of the Kalpar's test, we were asked the following 3 questions. Firstly, are the majority of the directors outside directors? Is the chairman of the board independent of the company? Are the compensation and audit committees composed entirely of outsiders? In the case of Rio, the answer is yes to these 3 measures, which shows that they do have a good board with good corporate governance, and the CEO does not have undue power or pressure on the other executive directors. CEO Jean-Sébastien Jacques succeeded the previous CEO in 2013, about 3 years ago. Previous to this, Jean was employed as the CEO of the Copper Group, and previous to this he was a strategic director of the Tate Steel. So he has good insider knowledge of the way the Rio business runs, which is positive for the CEO to have that experience within the company. The CEO's remuneration is set up with a mixture of salary and options. The non-executive directors have a fixed salary with no incentive programs. This can be seen as a negative as they don't have the financial incentive to perform. All of the board members have experience sitting on other boards. Rio's board members all own an equity stake within the company. The total value of the board's ownership of shares is around $7.6 million. Whilst this represents a tiny stake in Rio's overall equity value, I think we could agree that $7.6 million is a fair bit of skin in the game. This is seen as a positive for the board and the executive directors. The following table outlines the top 5 holdings of Rio's shares. As we'll see, this is dominated by institutional investors and superannuation funds. Researchers found that institutional investors prefer large companies with an international operation and, importantly, with good corporate governance. A final word on corporate governance. This brief overview has shown that Rio does have good corporate governance with their independent executives on their committees, the board of directors or having a financial stake in the company, and institutional investors and superannuation funds happy to invest in the company. All these indicators show that Rio have good, strong corporate governance. In the 2018 financial year, Rio reduced its debt by $4.1 billion to a cash positive position. 3 major rating agencies rate Rio as investment grade, with Moody's giving an A2, Standard & Poor's A, and Fitch A. Rio's share price has performed strongly over the past 15 years, with the exception of the 2008 financial crisis. Rio's 1-year growth to March 2019 has been 32%, outperforming the ASX by over 29%. Rio is a popular share for analysts and rating agencies. As of April 2019, that the majority of analysts rated Rio as a hold. Bloomberg rates Rio's social constraints and responsibility against history as environmental, performing better, social, performing worse, and governance, performing better. The following section will provide an overview of Rio's financial performance over the past 15 years. The R squared of the regression analysis shows that 31.4% of the variance can be attributed to the market risk, with the 68% residual able to be diversified out by buying other shares. Jensen's Alpha confirms that Rio has outperformed the broader market with a result of 0.87% per month. The levered beta of 1.365 shows that Rio shares have experienced greater volatility than the broader market. The expected return for Rio is calculated at 3.62%. This figure represents a benchmark for both investors and management. So the cost of debt at Rio is calculated at 4.5%. When adding in lease obligations, the cost of debt goes down to 4%. The after-tax cost of debt is calculated at 3.2%. The weighted average cost of capital is concerned with the weighting of debt and equity. The estimated market value of Rio's debt is calculated at $14.8 billion. The market value of equity, $36.1 billion. The current market capitalization of Rio is therefore debt plus equity, $14.8 billion plus $36.1 billion equals $50.9 billion. From here we can calculate the debt to equity ratio being 22.8% debt to 77.2% equity. It is now possible to calculate the weighted average cost of capital. As the following slides show, the calculation is 3.52%. We will commence this analysis by looking at Rio's existing investments and some ratio analysis. An assessment of Rio's competitive advantage and strength will be completed using Porter's 5 forces. Rio's return on invested capital was calculated at 31%. This is a premium of 27.6% over its weighted average cost of capital. A good return in anyone's book. In 2018, the Rio board and operations, investments and projects added an economic value of $12 billion to the firm. Rio's current ratio is calculated at 1.9 times compared to BHP's ratio of 2.5 times. Both of these ratios are quite high and show that these companies have current assets of around double or more the current liabilities. The ratio of return on assets shows Rio achieve 15% compared to BHP's 3%. This shows that Rio is achieving much greater return on assets compared to BHP. Dividend yield calculated for Rio and BHP are both roughly 4%, which shows the tendency in many industries for competitors to set dividend policy close to their competitors. Rio's competitive strength against competitors and also other introduced technologies has been assessed using Porter's 5 forces. The following figure shows Porter's 5 forces for the resource industry in relation to Rio's competitive advantage. In this section we will look at Rio's current financing and look at the power of debt and what Rio gets in return for taking on debt, namely the tax advantages. Costs of debt include a risk of bankruptcy and the incurred costs, agency costs within the business, transferring wealth from bondholders to shareholders potentially, and loss of future flexibility. One consideration for Rio's debt structure is its multinational operations. It has projects in mines all across the world with different rules, regulations, currency rates, etc. So their decision isn't based just in the pound of London or the Australian dollar. It's all across the world, and each investment needs to be based on the merits of that country and of the project. The analysis shows that Rio's optimal capital structure sits around 40% debt to capital. We find that Rio's actual debt to capital is 36.97%, pretty much right in the sweet spot. Utilizing the adjusted present value approach, again we find that the optimal debt to capital level is between 30 and 40%. The following section will look at Rio's dividend policy. Daniell has found that earnings and dividends are positively correlated over time, and that dividends tend to be sticky, meaning that once a dollar figure is being set, They generally don't like to drop it in businesses because that sends a negative signal to the market, which may have a negative impact on your share price. Rio's average dividend yield since 2004 is 4.89%. In the past 5 years, this has increased slightly to 6.9%. The dividend paid in last March 2019 was a healthy 11%, including a special dividend component of $3.39 per share. It is expected that Rio's dividend yield will maintain around 6.5% to 7% moving forward. Rio's dividend payout ratio has been calculated at 78%. The combination of high dividends and special dividends represents that Rio is a mature company in the life cycles. When it comes to dividend policy, the fact that Rio has institutional investors and super funds definitely means that they prefer steady, reliable, predictable dividends. This leads to a clientele effect at Rio, which if they were to change their dividend policy significantly, say reducing it to fund new projects, you would find that there'd be a major drop potentially in the share price. Dividend hungry investors leave to go find other investments. Cash trust nexus is around how the company performed, how much cash it gave back to investors through dividends versus how much it retained in earnings. With those retained earnings, the key question is, did they make a profit? Did they manage that money well? And its return on equity, the retained earnings, was 31%. It compares very favorably to BHP at 6.6% and Fortescue Metals at 9%. The two-stage dividend discount model shows that as of 30th of June 2018, Rio shares were undervalued. Free cash flow to the firm method shows that at 30th of June, Rio shares were undervalued. Price to earnings method of analysis shows that at 30th of June 2019, Rio shares were undervalued. The reason for the different valuation prices using these methods is the way they look at the business. The dividend discount model looks purely at dividends, doesn't look at earnings or cash flow. Free cash flow to equity looks at net income plus depreciation, not just dividends alone. Overall, we see Rio as well managed. The board is getting good return for retained earnings and paying a healthy dividend as well. One recommendation for Rio is that they continue to look for opportunities in the market to invest in new technologies where valid. Ones that would complement their current mining activities. They don't want to be the blockbuster video of the future, holding on to an old business model and watching it fly by, while new competitors and new ways of businesses and technologies take over your revenue streams. New technologies will create new ways of doing business and a demand for new resources. So Rio should really invest a portion of their profits in ensuring that they keep up to date and invest in innovative businesses which may be tomorrow's major competitor.